Hey gang, it's Dave Littlejohn back for another episode of Investment School. Today we're talking about IRAs and whether or not you can get them for your kids. So stick around, we'll be having fun. Hey gang, it's Dave Littlejohn back for our next episode of Investment School. And today is a question and answer day. We got a question after our last video from Gary who asks, hey, can I put money into an IRA for my child? And this is a great question because there's actually a lot of layers to it. So first there's a question of, well, what kind of IRA and how old is the child and what are the rules around IRAs and contributions? So they're all rolled up in here, so I'm going to talk a little bit about that today. All right, so for Gary and for everybody else that has this question, let's look at a couple different scenarios. So you've got a kid that is at a point where they're working, okay? Now, there's two forms of work. There can be like, hey, I'm doing some work at home and my parents are just gonna pay me a little bit for doing some babysitting, something like that. That is less documented. And there's, hey, I got permission, got a job, and actually have an income. The thing about IRAs that's interesting is, see, they don't really care how young you are. They care how old you are. I'll talk about that in a sec. They just care whether or not you have earned income. Okay? You can't contribute to an IRA if you haven't earned any money. Okay? If somebody gives you money, that's not earned. You can't contribute that. If you inherit money, that's not earned. You can't contribute that. It has to be earned income. Now, you're under 18, you can't write a contract for yourself, that's an issue. So what if you don't have traditional employment? Then what you want to do is document what you earn, and it needs to be realistic. It can't be like, well, I did dishes for mom and dad and they paid me $150 an hour. Okay, that's ridiculous, and the IRS is going to sniff that out and say, no, no, no. Okay, you get paid a reasonable wage for what you do, and you document it, and especially, hey, I mowed the lawn, this, that, or the other, even better, I mow the neighbor's lawn too, and I document, then you've got an audit trail, if you will, to justify where the earned income came from. Otherwise, if you got a W-2 or something like that, you're gonna see it, and the IRS is gonna see it. So that's pretty easy. You can contribute to that. Now, here's where it gets a little bit interesting. Your threshold, how much you can put in an IRA, is based on how much you earned. So the maximum in 2019 that you can contribute to an IRA if you're under the age of 50 is $6,000. So if you earned $7,000, you could put $6,000 in, right? Like your kid could. If your kid earns $5,000, they can only put $5,000 in. That's as much as they've earned, right? That's the earned income amount. But what if you're a generous parent? What if you say, well, I was gonna put the money in for my kid? Well, great idea. I mean, if you want to give them a good start, I'm totally glad for you if you're in a position to do that, but it's still going to be limited by what they put in. If your kid says, well, my kid earned $3,000, that's what can be put in. The IRS actually doesn't care if you put $3,000 in for them and they spend the $3,000 they earned, because from their perspective, the kid could have contributed their own money and you just gave them $3,000. So that's not the issue. They just have to have earned the money to put it in. Okay, now, what type of IRA makes the most sense? Okay, this is an interesting one, but I think it's a pretty straightforward answer. When you are expecting to be in a higher tax bracket in the future than you are today, Roth IRAs, if you're eligible, make a ton of sense. And if you are only earning a few $1,000s as a minor, you're going to be eligible for a Roth IRA. And that's a really good one. Why Roth? Well, the traditional IRA means I take money and I get to contribute into this retirement plan, and I then don't pay the taxes until in the future when I pull the money out for retirement. Roth IRA says, tell you what, let's just go ahead and pay the taxes now, because then in retirement, I don't have any taxes owed on that Roth money. It's really cool, right? The IRS either taxes you on the way in or they tax you on the way out. But the trick here is, remember, if you earn just a little bit of money, they have what's called a standard deduction. So, hey, I've earned income, I filed taxes. If I take a standard deduction on my taxes, I may show zero income, but I can still have earned income to contribute to my retirement. So you could have a Roth IRA and really have no tax due. right? No income tax because I didn't make enough money to pay income taxes, but I made enough money to put it into an IRA. Well, that's Roth IRA. That would be after-tax money that I owed zero tax on. Now it can grow until retirement, and when I get to pull it out, tax-free money. So that's a really cool deal, is if you can get a kid started with a Roth IRA. It's also cool because Roth IRAs are flexible instruments. They can often be used for first-time home purchase or for education expenses. So, useful tool. Okay, so my recommendation typically, and I use that term carefully because financial professionals are not supposed to make recommendations, but I think you really need to take a strong look at the Roth IRA. Typically speaking, that's going to be what makes the most sense if you've got a minor. Otherwise, traditional IRA is the deal. Now, I want to come back to one last point on IRAs. This particular episode is not about how do IRAs work necessarily, but an interesting element comes up. Because IRAs are individual retirement accounts, whether they be Roth or traditional, there are key ages. And remember, the IRS doesn't care how young you are, they just care if you have earned income. But they do care how old you are. Because unless you follow certain specific rules that I'm not going to cover today, you do not take money out of an IRA before age 59 and a half, or you will pay tax penalties. That goes for a Roth as well, unless you're taking it out after, again, certain qualifying circumstances. So the Roth IRA has to have been in existence for at least 5 years, and then you can pull principal back out. But all that earnings could still be potentially taxable if you take it out early. And when it's taxable, it's ordinary income, right? So you're going to report ordinary income on your taxes, and you're also going to have to pay a penalty of 10% on top of your income tax rate. So it gets expensive. So you think about retirement plans as exactly that. Retirement after age 59 and a half. Or again, we talked about education and some other specialty issues where I would say speak to your financial professional or tax advisor if you're going to go down that path. The final one though is there's another age. And it goes back to our conversation about Roth IRAs. The other age is age 70 and a half. When you reach age 70 and a half, if you have not started taking money out of your traditional IRA, the IRS says, I've been patient, I really want the money, I need the taxes. And they will make you take mandatory distributions after age 70 and a half. What's interesting is the Roth IRA, remember, they get you on the way in or they get you on the way out. The Roth IRA is funded with money you already paid taxes on. So at age 70 and a half, there is no required distribution from your account. It's significant from a planning perspective because when you take money out of an IRA, it becomes taxable as income. If you have Social Security income or pension income or you're still working at that point, it all goes in the pot and pushes your tax rate higher. Whereas if you have a Roth IRA, not only do you not have to take the money out, which drives you into a higher income bracket, but it also means that if you wanted to take the money out, it's not going to be taxed, which is cool, right? Because I don't know about you, but I like paying lower taxes. I'm not anti-tax, I just don't want to pay more than I need to. So that's the tricky part about, hey, why we like Roth IRAs. The other one, and again, a subject for another video, is someday when you're not here, somebody else gets the IRA. The tax treatment on Roth IRAs is more favorable than traditional. But the main crux of today's was, how much can I put in if a kid wants an IRA? And again, not based on their age, based on earned income. And if your income is not being documented with W-2s, then I strongly encourage you to have some kind of audit trail to document where the money came from. You may never be asked for it, right? It may never happen. It may never come up in an IRS audit. But if it does, remember, fortune favors the prepared. So there you go. All right, that's it for this episode. Thanks for tuning in, and until next time, if you've got questions, make sure to put them in the comments. You can also email us, right? We've got the email address. We're on the social media environment here, so check out Little John FS is where we've got a lot of this stuff. You can also just call, and we would be delighted to help you with that. But this one, just like I said, feel free. Phone a friend, share it, do all the stuff you do with social. You know why we do these things. We want to get the word out. But thanks, and until next time, this is David Littlejohn. Take care.